Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over the 18-year property cycle. I'll show you what that looks like. The reason it's so important to understand this is commodities do well during a certain portion of the cycle, and that's the expansionary phase of real estate. And the reason I look and dwell so long on the real estate cycle is because that is what determines and paces everything. Inverted yield curve, all that other, it's all garbage. It's all garbage. This is what drives it. The inverted yield curve exists because of this. The housing crash at the end of a land value crash blows everything out. That is the most important thing to understand of anything. Everything else is just numbers basically describing the market conditions of the real estate cycle. So I want to talk about the real estate cycle. I'm going to show you guys what it looks like. I'm going to show you what the 18-year cycle looks like. I've talked about the real estate cycle before, maybe not so much in the 18-year cycle. And then I'm going to give you a bunch of data of where we are today and why I think that we've got a very unique situation on our hands. And I think it's a little bit difficult to identify exactly where we are in the 18-year cycle. But I've got my opinions. People can disagree with those opinions, and that's fine. But at least you'll know what my opinions are and why I think where we're at. So this all spurred off of a question. Here's the question. It says, thanks, I've watched your latest videos and read your posts. You're too bullish. I think you need to explain why you're fighting the Fed. Rates long, whole year, recession, all prices are down. Now, I'm going to flip this around and say, I'm not fighting the Fed. The Fed is fighting the expansionary phase of real estate. And historically, they have not been successful. They have failed every single time in trying to fight the markets. So when someone says, oh, this is assuming the Fed will be successful, this is assuming that this time will be different than historical measures. And we'll take a look at it. We'll take a look at it. And there's some things that I think make it maybe perhaps a little bit more difficult to figure out. So what I've got here is I've pulled up some information here. This is the 18-year property cycle. These are property values coming up here. This is our date or time frame on the bottom. Generally, this is a general cycle here. You get the 18-year property cycle. You get 7 years, a wobble in the middle, 7 years, and then a 4-year decline of a recovery phase. So this is a recession phase, a recovery phase. This is the expansion phase up here. And this is your hypersupply phase in the winner's curse. Hypersupply phase. That is, we need to really dig down and understand each of these phases. This phase here is basically a recovery phase that is underneath the average of housing starts. As you go above the average, we get this wobble here. This is where I think we're at, is the wobble somewhere. I don't know if this could be maybe 2020, this could be 21, 22, this could be 23, 24, somewhere in that range. I don't know. I think we're in the wobble. That's where I think. And then we go into a large expansionary phase of housing. Then we get a hypersupply phase. The hypersupply phase means that you've got a bunch of inventory of new homes and existing homes, because the new homes would go into existing homes because they exist. It's not a bunch of homes that are in the process of being built. And then we've got the big crash of the housing market. Now, that's the cycle. This cycle might be a little bit different. It might be 11 years here, because we went from 2010 or so all the way to this peak here. Maybe it's 10 years, or no, it'd be longer. Wait, 2010 all the way to about 2019. It might be 9 years. 9 or 10 years to here, probably. In this general vicinity. Now, when we look at home prices, these are the median cost of a home by state. And I'm just using this to see where the cycle is. This is the last cycle here. The last cycle coming up, we basically turned and then we went back down. That cycle started in 2010, the recovery phase, I think. This was the recessionary phase from 2007 all the way to 2010. It's about 3-4 years. Then we started coming back up. And we haven't really had the wobble where we go down. I mean, maybe you consider 2020 a wobble, but that's also an external factor. Then we had QE. They suppressed rates. It created this big move. And I'm not sure if this move's done yet. We might still need to get through this wobble. And I'll show you where the housing starts are at. I don't think we've made much progress in terms of building homes to actually build down the deficit. So we are undeniably in a construction cycle. We ramped up new housing starts, and we ramped up the inventory of new homes. So if we were to look at the cycle and just kind of look at the dates of the cycle, we could say the recovery point, 1975, 55, 93. We had the wobble in 61, 81, and 2001. This is where I think we are at, is 2001, doing the wobble like we are today. Then we peaked at 72, 89, and 2007 in the top of the market high. Then we went into a recession, and these were big recessions. A lot of those recessions. And then you can see the bottom here, 2010, 2011, 93, and 75. And then it repeats again, the cycle. Why do I think we're at the 2001 cycle? Because everything points to a 2001 timeframe. What is everything? You can look at the stock market rolling over. It's basically just like 2001, 2002. You can see a shift in the bond market. Granted, a shift in the bond market is like 1981, where that was rolling over in that time frame. We can see that we just entered an expansionary phase of real estate. That puts us at 2001. We didn't build down, and I'll show you what that looks like. So I think we're in the 2001-ish area. If we were to answer here what deficit of homes we have in the market, why we are in a construction cycle, it says the answer is to build more, a lot more. Rough estimates of what economists call the housing gap, how much the United States would have to build to bring it back in line with historical trends, aren't difficult to come by. Looking at the number of American households and the number of vacant housing units, Freddie Mac, the government-sponsored purchaser of mortgage-backed securities, estimates a current supply shortage of 3.8 million units, driven by a 40-year collapse in the construction of homes smaller than 1,400 square feet. The group Up for Growth also arrived at an estimate of 3.8 million using data on the total demand for housing and the overall supply of habitable available units. And then the National Association of Realtors compared the issuance of housing permits with the number of jobs created in 174 different metro areas. It found that only 38 metro regions are permitting enough new homes to keep up with job growth. In more than a dozen areas, including New York, Bay Area, Boston, Los Angeles, Honolulu, Miami, and Chicago, just one new home is getting built for every 20 plus jobs created. The NAR estimates an underbuilding gap of as many as 7 million units. Now, this is what the data is. I know people argue with this data. They say, oh, we've got homes. I don't know, guys. This is the data. This is what the experts in real estate, when you look at the numbers, they come up with an amount around 4 million homes that are short. If that is the case, we've seen inventories drop all the way down to as low as 1 month or less in a lot of these cities. So I think that there is the demand there. Then it becomes, what is the affordability? Because we've had interest rates rocket higher. And we've had the fastest interest rate hike in a very long time. And that also makes me think we're in the wobble area because the market needs to digest all of that interest rate hike. Now, we look at the U.S. foreclosure starts. If we look at the last foreclosure starts, and I know this got cut off here, we had a massive increase in foreclosures before the peak of the housing market. The peak in the housing market was over here in 2007. So we had a massive increase in foreclosures. Our foreclosures, given the latest data of 2022 quarter 3, is off the chart low. And even if this were to go up at the same rate as the previous cycle, which basically had a bunch of garbage loans, I don't think we have those garbage loans. I think we're in a much better situation than where we are back then. But let's say we have the same rate of increase, which I completely disagree with. This could be another 5 years before we actually get a housing market peak based off of where foreclosures are at, given where the foreclosures were at last time. It could be another 5 years. And that's probably what it is. It's probably going to be another 5 or 6 years. Now, here's the non-farm real estate foreclosures for the United States under different market conditions looking backwards. So non-farm is just basically non-farmland. So this is real estate. We had a massive foreclosure number back in the Depression area. I mean, this was a massive, they threw loans out to everyone. It was basically another repeat of this back in the mid 2000s and all those loans. That was the 30s. And it happened in the 1920s. They gave a bunch of bad loans. They all went bust. We had a gigantic deleveraging in the banking system, and that was the Great Depression. We came all the way back down in the 1940s. We bottomed. And then we started to basically slowly creep up as interest rates creeped up and went into a very large housing boom in the 40s and 50s. And it never really came back down. We went to an entirely new level. That's where that inflation came from in the 1940s, in my opinion. And I know we're looking at foreclosures here, but foreclosures remained quite low, and they started to increase even in the 60s. And we had an entire 60s and 70s boom in real estate. We look at the delinquency rates on single-family residential mortgages. This is kind of the first snapshot of where a foreclosure could come from. And we're at very low levels of this. We were at very low levels back in 2004, 2005, 2006, and then they started to ramp up with all those bad mortgages. Now, I'm not saying that this can't happen again. I'm just saying we are way earlier. We're probably still in the time frame that's very early than late. This still needs to turn back up. Now, it's possible it happens with the higher interest rates, and it's going to take time. So, do we have another 2, 3, 4 years left in this housing bull market? It's possible. And it's possible that we're back in 2001, 2002, where we basically go through a recession, we go through it, and then interest rates come back down, the affordability becomes better, and the housing starts to kick back on. But again, that is all speculative. And when you look at the checkable deposits and currency held by the bottom 50%, this is the first to 50th wealth percentiles. It's as if these guys are saving to buy a house or something. Why is there so much savings in here? Back in 2006 or 7 and 8, all those savings were depleted. We are at very high savings. So the people who can potentially buy homes have the most amount of money that they've ever had sitting in their checkable deposit, their bank account. Now, when we look at the real-time data here, so let's look up real-time data here. This is the United States housing starts. Our commodity booms went from 98 to 2007, 8 in that general time frame, and that's the real estate boom. This is an expansionary phase. This was back in 2000s, the mid-2000s. This here is your wobble. It came back and wobbled down in 2000 here. This looks very similar. We get a buy signal and we get a wobble here, just like this wobble here. Is that wobble the mid portion of that cycle? Because after that cycle, it went from 2000 to a peak of 2005. It was a 5-year run-up. Are we going to get a 5-year run-up in our housing starts? And why is that important? It is important because the Fed is trying to fight this. But here's the problem. They can't win. This is supply and demand. This is demographic driven and a shortage in the market. What are they going to do? Raise interest rates and hold them up there forever? What's their second portion of this act in the play that they're going to do? If what's going to happen is they're going to raise interest rates, it'll slow down the housing market. It will slow down the inflation potentially in this system, because a portion of the inflation, the consumer price index number, is housing. It's real estate. Another portion is crude oil and some of these other ones. Now, crude oil, I think, it's probably going to rocket launch at some point here and be quite resilient and move on up. The reason I think that is because there's shortages in the market. and China's reopening, and they're also doing stimulus in their system. So if they're doing stimulus in the system, I think there's going to be a great demand increase for oil because it's the number one master commodity. But anyway, I think we're in that mid-cycle wobble. And if I were to kind of do a bars pattern on this from the bottom, where I think we're at is basically that section there. And then we take this and I kind of just elongate it. That is kind of what I think is going on there. It's that same type of starting point and cycle where we're in the mid cycle. So I don't think we have not built nowhere near the amount of homes needed to satisfy the demand. Period. So if you were to kind of test this, and the way that you would test this is if we were at the peak and we were going to have a housing real estate crash, the way you would test it is you'd ask yourself this. If we are at the peak and we built too many homes, or there's a bunch of foreclosures and homes come on the market and exceed the supply of homes, or exceed the demand of homes, sorry, that supply would be great. And if we lowered interest rates, that means the supply would remain pretty much there. It means the demand and supply is oversupplied. So the interest rate coming back down wouldn't do anything. You're at the end of the cycle. You have to go through a 4 or 5 year recovery phase. The demand needs to come back. Now, are we in the situation where if interest rates were to go down to 3-4% or 2%, 2.5%, or whatever it was in the beginning, if it were to come back down, would the housing market be kicked back on? In my opinion, yes. I know tons of buyers. And I know it's not just me, but I know there's a lot of buyers out there looking for homes to purchase. When this happened last time at the top of the cycle, and I went through it, there was like no buyers. Everybody owned homes. Everyone owned homes. The home ownership rate was very high. Our home ownership rate isn't as high as it was last time, and I probably should have grabbed that data too. Maybe I can actually pull that up. Let's see if I can find it here. Home ownership. So we're looking for the United States home ownership rate. Man, they've got a lot of all the other ones. There we go. So here's the home ownership rate. We had a very high 69% home ownership rate. And right now, we're at 66%. We are at a very low 63% below everything at the beginning of this. And it increased. We've come back down, and we're still at about 66%. That's not a high home ownership rate. I mean, it is back in 1980, you could say. But it's nothing like the peak back at 69% for home ownership rate. And I've got crude oil down here. I'm going to go back and show you. So the housing starts, and you look at the housing starts, the commodity buy signal, commodity sell signal happen in the expansionary phase of each one of these. You can see the starting point and the end point of basically when we should be looking to get out. And this is the price of oil. Big old boom in oil, big old thing. And what this is the money comes into the system from new homes being built. That is inflationary. That inflation comes into the system, and it's basically too much credit or money chasing not enough goods. Now, what happens is there's a response, and we have to build more goods. If the response is delayed, which it always is, that is inflation. And if you're trying to build more goods, the number one commodity gets used the most, which is oil. And that's why it's an inflation sensitive asset. It's the number one commodity. It's used all over the place. So getting this cycle right is very important, because if we don't get a boom, we should stay long commodities. Commodities do well in the expansionary phase of real estate for the liquidity reasons. If we are at the end of the land cycle and we do have an oversupply of homes, then we got to get out. And could we have a little bit of a wiggle? Yes. And my question to other people is, what if the wiggle's done? How do you know that the recession hasn't already happened? when we increased those interest rates, we saw a decline. We saw 2 quarters of decline. And I know a lot of people are projecting that we could decline even more, and that is possible, but we don't know that. We're already seeing gold and silver take off. We're seeing oil remain very resilient. We only fell back down to 70 something bucks. That's not super low. That's not a crash, blowout crash. And I think we're going to resume upward, and that's with China being completely locked down and an SPR release. So they really pushed this thing down. So that's where I think we're at. I think we're somewhere where the housing starts would kick back on if we lowered the interest rate. And the interest rates might be a little bit too high because of the stimulus money that they pumped into the system. And they were doing QE to hold interest rates down. And I'm not so sure. I mean, people are taking the Fed at their word. I'm not. Because what they told me in 2020 is they said, we're not even thinking about raising rates. We're not even thinking about raising rates. And then all of a sudden, and they said, we're not going to raise rates. It'll be out in 2023, 2024 is when we are going to start thinking about raising interest rates. And here we are. They've done a bunch of rate increases in a row. And we're up, I don't know where we're at, 3-point-something% on the Fed funds rate. They raised rates massively. So they didn't do exactly what they said. Now they're saying, well, we're not going to lower rates. We're not going to lower rates. I'm like, okay, you already lied to me once. Who knows what they're going to do? And I know some people say, well, he's doing exactly what he says. Well, not really, because he said they weren't even thinking about raising rates. So we'll see. We'll see. I think if rates go down, I think that the housing starts will kick back on. I think that we'll go into an expansionary phase because of the shortages in the market that the experts are projecting. 4 million homes that are short. And remember, that's 4 million homes built over the average. That means that when we go above this, we've only made this little dent here, and then we're back at average, or maybe slightly above average. The average is probably slightly below this, but we haven't made any headway into that deficit. And remember, there's homes that get destroyed too, that the new houses are going to have to build and account for as well. We have a bunch of old homes that are going to have to be demolished and new ones being built. There's a life cycle to homes. So there's also that going on. So that's what we've got. And I understand that the demographic of the baby boomers, they could be passing away. It is a kind of a weird dynamic, but we'll see where it's at. We'll see, and I'm going to continue to monitor the housing starts, continue to monitor. And this isn't about home prices. What matters is the volume of housing starts, how much they sell. If prices come down and housing starts still sell, that is still inflationary. It's the volume of new loans being generated, not the price. Volume of new loans. All right, guys, if you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Definitely check out the website, finding-value.com. Become a platinum membership. Use the word discount in the coupon code. Get yourself a discount. We talk about this. I've got a lot of ways to play it, and which I think is the commodity bull market still coming. I think the imbalances are massively in the system for a whole bunch of different commodities. But that's what I've got for today. We'll catch you next time. This is Finding Value.